This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a major bank is severely insolvent, indicating that the global banking crisis is back and in a big way. I'm going to show you who this bank is and what drove them into insolvency and why it means that banks all around the world are also insolvent, putting us on the edge of the next major global financial crisis. Plus, we're seeing panic at the highest levels of the White House, and with the election looming in November, we're going to show you why they're so worried. And now let's head over to Bloomberg, where we picked today's story up with a headline: troubled China shadow bank Zhongxi files for bankruptcy. And this is a big deal because this is one of the biggest banks in China, and it's telling us that there are severe problems in the global banking system. Now, we talk about a currency shortage, and this is just another evidence of what's going on around the world, because when banks go insolvent, it means we have a global shortage of not just dollars, but could be, in this case in China, domestic currency as well. Let's talk about what drove them into insolvency and why that means that banks all around the world are in the same position, threatening to trigger what could be the next global financial crisis. Zhongxi said it obviously lacked the ability to repay its debt, which is an understatement, given, well, it's insolvent and now filing bankruptcy. An audit found Zhongxi's debts were as much as 460 billion yuan, compared with assets of 200 billion yuan. Now, how does this happen? How does a bank get so upside down? Well, it's simple, because when we take a look at a similar situation with the small and mid-sized regional banks here in the U.S., what happened is all of these banks bought a whole bunch of bonds at really low interest rates. They had no choice. Governments were issuing debt like crazy. Banks were forced to buy them, and then they did. And what happened then is central bankers drove interest rates up to sky-high levels compared to past cycles. And what that meant is all of these assets that the banks are sitting on are now deeply upside down. So anything that goes wrong at the banking level indicates that, well, they have no position to sell assets to stop a bank run or an insolvency phase or anything of that nature, which means Zhongxi is not only majorly insolvent as they head into bankruptcy, but it indicates that banks all around the world are facing the same situation, with anything that could push all of them onto the brink of bankruptcy and every central banker back to zero at the fastest rate you've ever seen in history. The downfall marks one of China's biggest ever bankruptcies, putting more stress on the already fragile consumer and investor segment. The property slump, weak domestic demand, and sluggish trade are all weighing on the economy, while its benchmark stock index has plunged 3 years in a row. Talking about opportunity, well, could be in the Chinese equity market. The Zhongxi filing came just months after the lending giant first triggered concerns in the financial markets when one of its trust company's affiliates failed to repay customers on high-yield investment products. And this is, again, where things start, is we go back to what this bank was investing in, and you start to see how the dominoes fall, and next thing you know, you find out your entire banking system is insolvent. And so it starts to make sense. Why is Beijing trying to prop up the property market? Why are they injecting stimulus into the banks to force them to lend? Why are they talking about forcing the banks to run unsecured loans? Because it's not just the property developers. It all has knock-on effects across the financial industry. And when one big bank goes, well, next thing you know, panic is going to set in, and consumers are going to yank money like crazy, which could trigger a massive deposit flight, just like we saw in the U.S. And while the firm's creditors are mostly wealthy individuals rather than financial institutions, of course, because it affects the wealthy, it doesn't matter, but it does in a big way, because limiting the direct impact on the financial system, the collapse exposes potential cracks in the 2.9 trillion trust sector. The failure also highlights the risks of rapidly growing global private debt credit market, where the lack of public disclosure on debts raised outside the banking system is one of its defining traits. So now you can imagine wealthy investors are going to be looking at their bank, looking at their investments and thinking, well, you know what, maybe it's time to pull those out. And of course, that's one of the worst things that could happen, because if all these banks are forced to sell their illiquid assets because all of a sudden investors are fleeing, well, you're going to see a wave of insolvencies and a wave of bankruptcies hit the Chinese banking system. That's going to then pass through the rest of the world, driving central bankers to get back to zero, to get these assets out of negative equity into the plus. And in recent years, even as rival trust-paired risks, Zhongji and its affiliates, especially Zhongrong International, extended financing to troubled developers, so here we see it, and snapped up assets from companies including China Evergrande. China's housing market continues to flounder despite a slew of incentives from Beijing to revive sales, which have now dropped in 20 of the last 24 months. So here you see the case. These banks went out and bought a bunch of bad assets from these property developers that are hemorrhaging as the real estate market collapses. And what did I tell you? It would eventually hit the banking sector. Zhongji is now the first one of those banks to go down. We're going to see more of them unless Beijing steps in a big way, which tells us that the likely path from the PBoC is to see rates go down and in a big way. And Zhongji is not the only one, because another bank, this company which has 4.96 billion yuan under management, acquires and restructures distressed assets to rescue troubled businesses and mitigate financial risk. Well, they're having problems as well, and they reported that Goho has submitted filings to the Shanghai and Shenzhen stock exchanges on January 2nd that said it was unable to pay debts of more than 298 million yuan because returns from some of the company's assets failed to meet expectations. And what this led is to some of the company's assets being frozen and confiscated. So now you can see this is just starting to flow downhill, creating more and more problems in the Chinese financial system and banking sector, which suggests, of course, the PBoC is going to have to do what most people at this point would consider the unthinkable. And that is, now China markets are betting big on further PBoC easing this year. Of course, what we know is when central banks ease, that could send stock prices higher. And how would you know that if the Chinese financial system, their stock market is at 3-year low, how do you know this is a huge opportunity? Well, you can take advantage of it. If you are a subscriber to our reports, let's first look at Momentum Timer Pro. We're going back here to December 20th. And here we've noted to our subscribers there was an opportunity. We even talked about it on our Sunday show. And what do we see on our 1-month window? We didn't get as deep a sell-off as we wanted, but we got a 1 daily buy count on the technicals, because what our Momentum Timer Pro report does, it looks at those technical indicators, those things like the RSI, the MACD, and all those other ones, and smooths them out, makes them easy for you to understand in one report. And then 1 day later, our CTA Timer Pro report, which looks at the machine positioning in the market, it came off of this deep short. We were telling our subscribers, watch for this. This was on December 21st, triggering a buy it open here. Now, you may remember from our QQQ trade that took off, there was an initial pullback. We're seeing that now. This trade would be down just a smidge, but look at this opportunity. We're down here to potentially 3-year low. And last time, as you'll see in a bit, this took off in a huge way, suggesting that if the PBoC cuts, Chinese equities could be a major beneficiary. And there's a growing chorus among economists calling for the PBoC to resume rate cuts after its last reduction in August. Now the Federal Reserve looks to reverse its historic policy tightening campaign later this year. And you can take advantage of these reports. There's links in the description. And right now, there are 3 coupon codes again for a free month. If you get there and there's no way to enter the code, well, it means 3 people beat you to it. Grab them before they're gone. We're going to be making the reports easier to follow here in this month. So get on your free subscription while you can for the first month, because a protracted housing slump and weakness in manufacturing also add to the sense of urgency. This for policymakers. A rate cut could happen as early as this month, according to Citigroup economists, adding they expect the PBoC's rate reduction to total 20 basis points and bank reserve requirement ratios to fall 50 basis points this year. Goldman Sachs has identical forecasts with a 10 basis point rate cut in the current quarter, the first likely move, again suggesting that this could be a boom for Chinese equities, because we know investors love when central banks cut. They flee into the stock market. As we're seeing pressure on the yuan and the dollar retreats globally in anticipation of a dovish turning Fed, offers space for the PBoC to step up its efforts as well. We've noted the dollar path likely to head lower, and sure enough, this means the Chinese stock indicator with 100% success rate It's now flashing a buy, and this is not based on our reports, but I just want to show you that how good our reports are at finding opportunities for you. Because look at this, this hit the news today. Compared with bonds, Chinese stocks have rarely been so cheap. At about 8%, the earnings yield on the CSI benchmark is 5.7 percentage points above the 10-year yield. And since 2005, the gap has rarely been this big. And similarly, the dividend yield of the stock benchmark has risen above the long-term bond yields for the first time since at least 2005. And again, the market knows what's going to happen here. If there are more problems in the banking sector, the PBoC is going to be forced to cut rates, bring them down to get those portfolios at those banks from a negative equity into a positive equity position. This is why I've been making the case that all central bankers around the world during the next crisis will be back at zero, trying to go negative to free up these assets from the banks that are going to be hemorrhaging and face major liquidity crisis. Again, investors are looking at this as a huge opportunity. There's been 5 previous periods in almost 2 decades that the stock bond yield gap has reached 5.5 points or more, including during the 2008 financial crisis and the pandemic in 2020. Stocks rose the following 12 months each time with a whopping return of 57% on average. And if you grab that, well, I'll tell you what, that'll pay for your research reports from my subscription for many years. But now let's turn attention to the White House, which is in major panic mode, and in for good reason, because we know the elections are coming in November, and now they've got a big problem. As Biden aid jobs data says consumers are seeing economic gains. Well, of course, we know that may not last based on what we're now seeing, and it's clearly working, and there's even some promising evidence that folks are beginning to feel it. This from Jared Bernstein, who chairs Biden's Council of Economic Advisors, touting a strong jobs report that he shows that U.S. economic recovery is resilient and poised to avoid a recession. That, of course, is until the labor market goes down and goes away. We know that is the likely case with 1.855 million Americans still on continued claims. That needs to go down in a big way. And based on all the things we're seeing, the continued claims is likely to head higher as companies go into the new year thinking they need to continue to trim heads. Selling voters on Biden's economic agenda will be crucial to his re-election hopes. This is where panic is starting to set in as he seeks to convince voters to reward him with a second term. And despite a string of positive economic data in recent months, polls show voters largely disapprove of Biden's handling of the economy, mainly because inflation went on too long and wage growth didn't keep up. And this is sentiment fueled in part by worries over high inflation that have hit consumers in their pocketbooks. So as we look now at anything that could send inflation higher is a major problem for the White House. I'd say we're on a path out of the woods, but our work is not done, he said on Friday. Both wage growth and price growth have decelerated some, this according to Bernstein, knowing that wages have been beating prices for a while now. Well, not so much now, and that is extremely important, and this is what they're referring to so far. Just for most of 2023, we've seen total compensation in the form of average hourly earnings multiplied by average weekly hours of production to non-supervisory employees. That shown on a year-over-year rate of change, beating inflation. That shown in blue, but little too late because we know for 2 years we see consumers were way behind and they have to play catch up. They've got a ton of debt. They're carrying a bunch of that now from the holiday season as well. Tells us consumers need to see inflation come down in a big way. But the problem is, it may not, and even worse, and now may start to impact the labor market. As Red Sea attacks bring risk of higher prices for Americans, as according to Biden officials, they're getting worried. As I worry about the geopolitical space we live in, this from Shalandra Young, Director of Office of Management and Budget. She said this on Friday. The Red Sea attacks, shipping, all of these things in geopolitical space certainly have the chance and opportunity to raise prices on the American consumer, and this would not look good for President Joe Biden as he heads into the election in November. Because remember, we know these things show up in the CPI with a lag, so this is a big problem that he needs to deal with immediately before it gets out of hand. And Young is the latest U.S. official to highlight worries about the ripple effects of a wave of missile and drone strikes on ships in the Red Sea. President Joe Biden's allies are acutely concerned about what that could mean for the White House's efforts to curb inflation, a political liability for Biden ahead of November election. So look for him and his team to squash whatever other problems are showing up there to get the shipping lane back open, get commerce around the world moving, because he's going to need a big success there to show the American public, if he's going to have a chance at re-election, to say, look, I saw this as a problem and I dealt with it. Because if it gets out of hand and consumer prices head back up, well, his chances of re-election, as many of you know, go way down. Persistent inflation has played a major role in voters' poor perceptions of his handling of the economy, as the administration is particularly sensitive to the impact of high prices on consumers as the president touts his Bidenomics agenda, which the White House says helped bring down crippling inflation post-pandemic, much of it due to smoothing supply chain crunches. Well, don't tell that to Fed Chair Jerome Powell. He's the one that's going to want to take credit for his work. But the problem now is this means that the U.S. labor market could be at risk if the Biden administration doesn't get that shipping lane open and fast. Because global shipping delays cast shadow over strong December jobs report. Of course, we noted there's a lot of problems underneath that report, as White House officials are keenly aware of the risks that shipping holdups could trigger a domino effect within the U.S. supply chain, which only recently appeared to recover from the impacts of COVID-19. And given what occurred during the pandemic, we're very sensitive to the impact of supply chains and logistical logjams of the economy. This, according to Jared Bernstein, again, the chair of the White House Economic Council of Economic Advisors. He noted that he did not mention the potential fallout for global manufacturing and consumer goods if the Red Sea remains too dangerous for major shipping lines to enter. And so what happens is, if goods can't move, think about this, manufacturing bases around the world grind to a halt. And guess what happens next? Well, that means the manufacturers don't need people standing around. They put them on the unemployment line. Their incomes go down, their consumption goes down, and next thing you know, you're triggering, again, a globally synchronized recession. All that matters now is what's going on in the Red Sea, as current delays have already affected several companies that sell products in the U.S., including Sweden-based IKEA and British appliance firm Electrolux. Biden's national security team is, quote, working with a broad coalition of partners and in close contact with shippers on this. Keep in mind, he's going to do anything possible at his power to get that shipping lane open and get it done fast, because if we see this leak into consumer prices and cause them to go up, what that means is the Fed then has to react accordingly, has to come back, potentially raise rates, and we know the Biden administration would want nothing more than to see inflation come down and the Fed cuts rates. The problem is they don't realize that if the Fed is cutting rates, it's not a good sign. It means the U.S. economy is indeed slowing and in danger, because in the past, when the Fed cuts, they don't just one or two, they do a bunch. Of course, as we now look back to China and the potential banking crisis, if you see all this start to spread around the world, because again, you think about global shipping, you think about global trade, the banks are highly involved in this. If things go wrong, next thing you know, we're at the tipping point, heading on the way down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.